Welcome back to the channel. I think every investor wants to know, is the stock market overvalued right now?
Yeah, it's a question we all ask.
So to try to answer that, we're going to use something called the Buffett Indicator.
Oh, yeah, this is famously used by Warren Buffett, gives us kind of like a bird's eye view of the market.
So how does it do that?
It compares the total value of all publicly traded companies in a country to its gross domestic product, or GDP.
So you're
Uh,
saying it compares the stock market's total value or market cap to the economy.
Exactly. The
That's not,
formula's pretty simple, actually. It's total market cap divided by GDP, and then you multiply that by 100.
okay, so that gives you a percentage.
Right. And around 100% usually means the market is fairly valued.
Makes sense.
But if it's higher than 100%, that could mean the market is overvalued.
And if it's below 100%,
Then it might be undervalued.
interesting. So where does that put the U.S. market right now?
Well, as of October 28th, 2024, the U.S. market's Buffett Indicator is 200.9%.
Wow, over 200%. That's
Yeah. Historically, whenever it's been over 200%, that's been like a warning sign.
like a red flag
Yeah,
that the market might be too hot.
exactly.
Interesting.
Think about the dot-com bubble back in the early 2000s.
Man.
The Buffett Indicator was going crazy back then, way above 100%.
And of course, then the bubble burst.
Right?
So are we headed for another crash?
Well, it's important to remember that the Buffett Indicator, it's really meant to be a long-term gauge, not something you'd use for like day trading.
So we shouldn't panic just because it's high right now.
Yeah, and
Well-
plus the world's a lot different now than it was during the dot-com era.
Oh, for sure.
So the Buffett Indicator might need some tweaking to, keep up with all the changes.
Yeah. Okay, I see what you're saying.
Yeah.
So what are some of the limitations of the Buffett indicator as it stands?
Well, for one thing, businesses are way more global these days.
Oh, yeah. Lots of American companies get tons of revenue from other countries,
Exactly, and that isn't really reflected in the U.S. GDP.
which the Buffett indicator uses. Okay, that makes sense.
And we also can't ignore the impact of those really low interest rates we've had for years.
Yeah, those have pushed up the prices of everything, stocks included.
Exactly. So that could be skewing the Buffett Indicator upwards, too.
Okay, so are there any other limitations to consider?
Well, and another big one is the rise of all these companies that have, huge intangible assets.
Like intellectual property, brand value, software?
All that stuff, yeah.
Yeah.
And those assets, they're really hard to put an accurate value on.
So the Buffett indicator might not be capturing their full worth.
Exactly.
Okay, so the Buffett indicator can be a useful tool,
Yeah, definitely.
but we need to consider it within the context of today's complex economy
Yeah,
and use it alongside other valuation methods.
absolutely.
Okay, cool, makes sense.
Yeah. Yeah, it's like using an old map to navigate a new city, right?
Yeah, I get it. So how can we adjust for these limitations? Like how can we make the Buffett indicator more useful today?
Well, one way is to use it to compare different countries.
Oh, like to see if one market might be undervalued compared to another?
Exactly. Like even if the U.S. market has a high Buffett Indicator, another country's market might be even higher.
So like if the US is at 200%, but say the UK is at 150%.
Yeah, then that might suggest that the UK market is a better deal, relatively speaking.
Okay, so it's all relative.
Right. It's about context.
Got it. But even within a single market like the US, we can't just rely on the overall Buffett indicator, right?
No, definitely not. I mean, just because the overall market seems overvalued doesn't mean every company is overpriced.
Right. So we still have to look at individual companies.
Absolutely. A high Buffett Indicator just means we need to be more careful.
Okay, so what else should investors look at when they're evaluating individual companies?
Well, all the traditional valuation metrics, those are even more important now.
Like price to earnings ratios, price
Mhm.
to book ratios, all that.
Exactly. We need to make sure we're not overpaying for a company's potential.
Right. We don't want to get caught up in the hype.
And we also need to look beyond just the numbers.
Oh, yeah, the qualitative stuff.
Right, like how strong is the company's management team? What are their long-term growth prospects? Things like that.
So it's about combining the numbers with the bigger picture.
Yeah, basically.
And in today's market, with all these intangible assets.
Right, those are super important to consider too.
But they're hard to measure.
Exactly, which is why it's so important for investors to do their research, you know?
Yeah, really understand the businesses they're investing in.
For sure.
Okay, so the Buffett indicator might not be perfect,
Yeah,
but it's still helpful.
definitely. It's a good reminder to always be skeptical of the market.
And to do your own research.
Absolutely, and to not overpay for things, even if the market seems like it's booming.
Right, because the market doesn't always act rationally.
Yeah, especially in the short term.
Okay, so
Mm,
bottom line,
yeah,
the Buffett indicator can be a good starting point,
for sure.
but we need to use our own judgment and manage our risk carefully,
Exactly.
no matter what the Buffett indicator says.
Right, because at the end of the day, it's up to each investor to make their own decisions.
Right, to decide how much risk they're comfortable with.
Exactly.
Okay, so if the whole market seems a little risky right now,
Yeah.
what does that mean for individual investors?
Like, should they change their strategy?
Should they be more conservative? Maybe look into other investments?
These are all good questions to think about.
Yeah, we'd love to hear what you think.
Yeah, how do you use the Buffett indicator in your own investing?
And what other factors do you consider important when you're making investment decisions?
It's a good point. Yeah, I mean, the Buffett indicator, it's not a crystal ball,
Right.
but it does make you stop and think, you know?
Definitely. It reminds you that you can't just blindly follow any one metric.
Even if it's from Warren Buffett.
Right, exactly. And it also reminds us that the market, it can get a little crazy sometimes, you know?
Oh, yeah, driven by emotions.
Exactly. Fear, greed, all that.
But eventually, things settle down.
Yeah, in the long run, it's the actual value of companies that matters.
Mm,
Right, so the Buffett indicator, it can be a good tool
definitely.
as long as you use it wisely.
Yeah, it makes you ask the right questions.
And it helps you make more informed decisions.
Exactly.
Because like you said, it's not about timing the market perfectly.
No.
It's about building a solid portfolio
Right, with investments that you believe in.
and that fit your long-term goals.
Yeah, and your risk tolerance.
Exactly. So, as we wrap up here,
Yeah.
what's the main takeaway about the Buffett indicator?
Well, I think it's that even though it might not be perfect,
Yeah.
it's still a valuable tool.
Yeah, if you use it the right way.
Right. It helps you understand the market better.
And make smarter decisions.
Exactly.
So keep learning, keep questioning,
Yeah,
and keep investing.
absolutely.
Thanks for joining us, everyone.
Yeah, thanks for listening.
And we'll see you next time.